understanding the importance of financial planning. Why exactly is financial planning important? Well, it's important for a few different reasons, and let's talk about these reasons. Financial planning helps you with budgeting and spending control. Do you know where all of your money goes? This is probably a question you've asked yourself multiple times. You've probably heard the classic advice, don't spend more than you earn, and for good reason. While this quote is simple and everyone should abide by this, it's the golden rule of financial planning for a reason. Okay, budgeting helps you understand exactly where your money is going so that you can make smarter choices and avoid that dreaded paycheck to paycheck cycle. It's not about restricting yourself, it's about prioritizing what truly matters to you. Budgeting is about giving every dollar a task so that you're in control of your finances and so that you don't let your impulses guide you. Okay. Creating a budget helps you take control of your finances and set the foundation for achieving your bigger goals. It helps with identifying your goals and your aspirations. Okay. Truly want to achieve with your money. Whether this is retiring early, buying your dream home, or taking a once in a lifetime vacation, financial planning starts with your goals. Okay, think of it as a like a Google Maps. If you don't set a destination, you just keep driving in circle, not knowing where you're going or how you're. So that's why it's important to identify your goals and your aspirations. Okay. It also helps with risk management. Financial planning helps you manage risk. Okay. Life loves surprises. Some surprises are good, like a marriage proposal, and others are not so great, like a surprise divorce or a flood in your basement, for example. Risk management is about preparing for the unexpected and protecting yourself financially from life's surprises. Okay, whether it's a sudden job loss or a health issue, risk management ensures that you have a safety net in place for when your unexpected expenses or anything bad happens and you need money to cover it. Okay, so this is why it's important to do financial planning so that you can also make sure that you're protected in case of unexpected life events. Okay, this includes having the right insurance coverage as well, building an emergency fund for your unexpected expenses, and making sure your finances can weather any storm. It's not about expecting the worst. It's about being ready for anything so that you can focus on living your life without constant worry. Okay. We'll talk about insurance, emergency funds, and how to prepare for the things you don't see coming. Okay. So financial planning also helps with retirement planning. Okay. Have you ever asked yourself if you'll be able to retire one day, or how to make sure that when you do retire, that you don't outlive your money? This is a fear that a lot of retirees have, or a lot of people have, being able to actually retire and also being able to retire and be able to afford all of your retirement expenses without outliving your money. These are critical questions because financial planning isn't just about the here and now. It's about ensuring your future is secure. Without proper planning, you might find yourself working longer than you'd hoped or cutting back on your lifestyle in retirement. So, addressing these concerns early gives you the confidence to face the future, knowing that your money will last longer for you. Okay? It also helps with investment strategy that aligns with your goals. Investing isn't just about growing your money, it's about aligning your investments with what you want out of life, basically. A tailored investment strategy ensures your money works for you. The right plan balances risk and return to help you reach your goals without unnecessary stress. Okay. Financial planning helps you do tax planning as well. Why give the government more than you need to, right? So, tax planning helps you keep more of your hard earned money by taking advantage of deductions, credits, and tax efficient accounts. A solid tax plan uh, ensures that you maximize savings today while preparing for a financially secure future, right? The financial planning options also include estate planning as well. Estate planning isn't just for the wealthy, okay? It's for anyone who wants to protect their loved ones. It ensures that your assets go to the right people with minimal costs, taxes, and hassle. Okay, a good plan spares your family unnecessary stress and guarantees your wishes are honored. I won't be diving into the specifics of tax planning and estate planning today in this webinar because these are areas that are highly individualized and they're best handled with the guidance of a qualified professional. So, consulting an expert in tax strategies, tax planning, and estate planning ensures that you receive advice tailored to your unique financial situation and goals, right? So it's better to always get it right the first time than to deal with costly mistakes later. So consult with tax planning and estate planning professionals to make sure that you have the right plans for your unique needs. Let's talk about financial goals. What exactly are financial goals? Financial goals are goals that you want to achieve financially for you, for your family, and for your future. These are basically milestones that you want to achieve in your life, right? These can be things like saving for a down payment on a house, for example, or wanting to retire at 50 instead of at 65, for example. These are all financial goals, and financial goals are different for every single one of us here. So it depends on everyone's mindset and everyone's goals and what everyone wants to achieve in their individual life. So it's important to sit down with yourself to be able to find out what you really want to achieve financially. So why is it important to set up financial goals? Well, a few different things show why it's important to set up financial goals. They give you direction and purpose. When you do set up financial goals, you know exactly what you want to achieve, right? When you do that, you know what you want to achieve and you know where you want to go. This helps you create a plan to help you achieve your goals, right? It's also important to set up financial goals because it gives you motivation and it gives you satisfaction. When you know your goals and when you actually achieve your goals, this makes you happy. It gives you motivation to tackle your other goals to be able to reach them as well. All right. So these two are the advantages of financial goals. They also help you with measurement and progress tracking. When you set clear financial goals, you know exactly what you're tracking. So when you set goals, you should always go back to look at those goals, see how far you've come, what more you need to do to be able to reach your goals in a timely manner, right? So that's why they give you measurement and progress tracking. Setting up financial goals also help you with financial security and freedom. Okay. When you do have clear financial goals and when you do achieve them, they give you financial security and freedom. Let's say, for example, that you're stressed financially. You're really stressed, and one of your goals is to pay off debt so that you don't have to worry about debt anymore. All right. So once you're able to be completely debt free, you will feel at ease with yourself, right? Knowing that you don't have any more debt, and this gives you peace of mind and security. It also helps with your financial freedom because debt also slows you down in your financial journey and for your financial progress. So it's important to have clear financial goals to help you with your journey in life, right? So there are a few different types of goals that you can have, right? Financial goals are can be divided into three different types of goals. They can be short-term goals. These are goals that you would aim to achieve within 1 year. So these could be, for example, saving for, um, let's say, for a wedding, an upcoming wedding, or paying off a credit card debt, for example, right? You would also have medium-term goals. Medium-term goals are goals that you want to achieve between 1 and 5 years. These are goals that could be, for example, let's say maybe saving for a down payment on a home, or purchasing a new car, saving to purchase for a new car, for example. These are medium-term goals. And finally, another type of goal would be a long-term goal. Long-term goals are goals that would take you more than 5 years to achieve. These goals take longer and they require dedication, okay, and focus. These would be essentially, usually maybe saving for your kids' education if you have 10 plus years to save for their education, or saving for retirement, for example, if you still have a few more years to save for retirement, right? So these are the types of goals that are available, right? So it's important to make sure that you sit down with yourself to actually think about what you truly want to achieve financially so that you can put them down and find ways to actually achieve your goals. Overview of budgeting and its importance. We discussed that budgeting is very important because it helps with you knowing how to allocate your money and where your money is actually going. It helps you make sure that you're living within your means and that you're not spending more than you're making, right? But why exactly is budgeting important? Well, it's important because it helps with financial awareness. Okay. Budgeting helps you get a clear understanding of your financial situation. When you budget, you know exactly how much you're making, you know exactly how much you're spending. And when you deduct your expenses from your income, you know if you have money left over at the end of the month or if you have a negative amount. If you do have a negative amount, that's when you need to cut back on things to make sure that you don't spend more than you're making, or you will have to get a side hustle or make more money to be able to cover your expenses. These are the two options that you have. But essentially, you absolutely have to budget to make sure you know how you're how you're managing your finances. Essentially, it helps you manage your finances. Budgeting also helps with expense control. It helps you control your spending, helps you allocate every it helps allocate the amount you can spend on every category of your monthly spending needs. So when you do your budget, you would have your income on one hand and your expenses, and you would allocate, for example, let's say $300 towards food, $200 towards car payment, and you would keep allocating all of your funds and make sure that you're not going over what you're making. And if you are, then you need to tweak it, right? So it helps with expense control. Um, Having a budget also helps with emergency planning. As we mentioned, unexpected expenses are part of life and they will happen. And when they do, you need to be prepared for that to make sure that you don't go and borrow money to cover your unexpected expenses. You need to make sure that you have enough savings in your account so that when you have an unexpected expense, that you would just go into your savings account and spend that amount instead of going to reach for your credit card to use it and have an amount of debt that you would not be able to pay for later. This is why a lot of people end up with a lot of debt because they keep using the credit cards for unexpected expenses, right? So you need to make sure that you have enough savings to cover you in case of an unexpected expense. And when you do your budget, that's when you allocate a certain amount of money for saving for unexpected expenses, right? So budgeting also helps with debt management. Like I said, it helps track your debts and manage your payments as well. So if you do have debt as well, doing a budget helps you know how much money you have left over to pay off your debts, right? So that's important too. And it also helps with your savings and your investments. It helps you prioritize your savings for your future goals, your retirement, down payment on a home, vacation, etc. Right? So budgeting helps you reach all of your financial goals. It helps you know exactly how you can achieve your financial goals. All right. So that's why it's important to make sure that you do your budget every month and that you tweak it every week or every 2 weeks to make sure that it still aligns with your goals and your financial needs. How to build wealth through saving and investing. Well, you can do that by following a few simple steps. One, you need to automate your savings. You need to pay yourself first. There's actually a finance concept that talks about paying yourself first. This is essentially a concept that says that it's important to treat your savings as if they are important bills. The same way that you make sure that you pay all of your bills on time, that's the same importance that you should give to your savings needs. So, paying yourself first concept says that after you've paid, when you're doing your budget, after you've paid for your essential items like your housing, so shelter, food, that's when you would automatically set up your savings needs to make sure that you are saving automatically and not even thinking about it. Studies have shown that the when you set up automatic savings, when you have money coming from your checking account and going directly into your different savings accounts, it makes sure that you don't see that money. So when you don't see that money, it's as if it doesn't exist. So it just goes into a different account and it keeps building up and you don't even think about it. So that's the best way to save. So, in order to build wealth, you need to create a plan to automate your savings. So, if you, after you've done your budget, if you know that you have, let's say, $300 left at the end of your budget, and that you have priorities to first save for an emergency fund, and that you can put $150 into an emergency fund savings account, you need to make sure that when you're paid, that you automatically have money going from your checking account to your savings account so that you don't even have to think about saving, right? So this helps a lot with building wealth. The other important thing is to save for your goals, your specific goals, right? You will need to save for vacations, a new car, down payment, etc. You need to make sure that you have savings goals for each of these important um, financial milestones that you want to achieve, basically. Okay. If you're purchasing a car, instead of going and leasing the car and having to pay interest, make sure that you save this amount upfront so that you can put maybe $100 every month for a few years to be able to reach that goal for you. This helps you buy a car you can afford, and it prevents you from getting a loan that you have to pay for 6 more years, right? So saving for your goals is very important, and it helps you with building wealth as well. It helps you get conscientious about your finances, right? And another thing to help you build wealth would be to start building an emergency fund. Okay, so it's important to build an emergency fund. Like we said, life is not a straight line, and unexpected things can happen. So in the finance industry, it's usually recommended to have 3 to 6 months worth of living expenses saved up in an emergency fund and in an easily accessible savings account. So this is why it's important to do your budget, because after you've done your budget, you should know how much you're saving per month approximately. If, for example, you did your budget and you saw that your monthly expenses were about, let's say, $3,000. So that means that if you need to set up an emergency fund, you need to have at least $9,000 into an emergency fund, right? So $9,000 into an emergency fund, that's 3 months worth of living expenses. Okay. And that's the minimum amount that you should have in an emergency fund so that things happen. You can lose your job. So that when you lose your job, you have at least 3 months where you can look for another work, and you don't have to stress about how you would fulfill your other expenses, right? So it's important to always have a an emergency fund so that you can have peace of mind, all right? And the other thing would be to open a separate savings account for each of your goals to help you to easily manage your savings, right? So if you have a goal to save for a car, save for a down payment on a home, save for retirement, you should have three separate accounts for these, right? So that every month, based on the amount that you want to put in each of these accounts, you would have money coming from your checking account to go into each of these savings accounts to make sure that you're saving specifically for each of these goals. The other thing would be to make sure you save for retirement. Saving for retirement is what will help you get to actually retire. If you don't save for retirement, you will not be able to actually retire because the amount of the government CPP, which is the Canada Pension Plan, will not be enough for you to retire on. Okay, I think the average CPP payment per month is about $780 per month. $780 per month. Clearly, this is not enough to retire on, right? So it's important to make sure you have enough money to retire. Another thing that's important to consider about building wealth is that when you do save for retirement, it's important to save for a longer period of time because there's a thing that's called compound interest, which is something that helps a lot to grow your savings significantly based on the amount of time you had saved for. We'll look at a few examples later where I'll show you the difference and what happens if you save for, let's say, 5 years, for example, versus if you saved for 10 or 20 years, right? So it's important to make sure that you have saving needs for your retirement as well. And don't forget your kids' education. A lot of parents, most parents, should consider their kids' education and should save for their kids' education. The government actually made this easy by creating a savings account, which is called the RESP, the Registered Education Savings Plan. This account helps parents and guardians save for their kids' future university or future education needs. All right. So, as an example, if you were to save $100 into an RESP, the government would actually put a certain amount of money based on your own contribution, right? So, for example, if you were to save $100 into your kid's education per month for 17 years, at the end of that 17 years, that kid would have an amount of 18,000. Um, that kid would have, sorry, an amount of $35,000 into a savings account where they can withdraw that money and you do an education with that and pursue an education with that. All right. The amount that you actually contributed for that 17 years was 18,900. The amount that you actually contributed to this savings account. Okay. The grants that you received that the government deposited into this account after you've deposited your $100 per month, the total grants that you received was 4,500. Okay, about 4,500, and the interest that you earned was about $11,000. So that's the interest that you earn on that money, right? So as you can see, with $18,000 that you deposited into an RESP, and with the government grants and the interests, your kid is getting $35,000 at when they reach the age of 17. So as you can see, saving for a longer period of time is very important, right? It lets you save just a little bit of money so that you can have that money compound for years and years, right? Another example that we can look at would be this example where if for example, you were to save, these are two examples that I'm going to show you. For example, if you were to save $200 every month with a 3% interest rate compounded annually, this is the amount that you would get at the end of that 10 years. Okay. 10 years, if you were to save for 10 years, this is 27,889. So $27,889 is the amount you would have saved. Okay. And with this $27,000, $24,000 is the amount you actually saved, and then the other 3,000 is the interest you earn on this. Now, let's say, for example, so this is the second example where everything else is the same. So you're saving for 10 years and you're saving for 10 years, $200 per month. But instead of the 3% interest rate, you have a 7% interest rate. So as you can see, this is the amount that you will get at the end of that 10 years, which is $34,210. Okay, so that's the amount that you would get. Now, as you can see, just because of the difference in interest rate, you are making a lot more in interest. Look at this. Instead of 3,000, you made $10,000 for the same amount of time. Okay. And the last example would be um, saving $200 per month for 25 years instead of 10 years. And as you can see, if you save for 25 years, you're getting $156,000, right? So as you can see, it's very important to to consider a few different things. You need to consider when you're saving, you need to not only consider the interest rate that you're getting on your savings, but you also need to consider how long you're saving for. These are the two components that are really important in your savings journey, and they are really important to help you build wealth, right? By when you save for a longer period of time, your money has time to grow faster. All right, it has time to grow longer because as you're saving, the money that you have in that account keeps getting interest, and the interest that you earn on that account also gets interest. That's what's called compound interest. So the longer you save, the more money you get at the end. This is why it's important in the finance industry. We actually promote being able to save at an earlier age, right? Instead of for waiting until you are maybe 40 or 50 years old to save because you're not maximizing your savings needs. Another component that's important in the savings industry is the interest rate you get. So it's important to make sure that you get a good interest rate on your savings to make sure that you can get there faster. By maximizing these two options, you can save for your financial goals and get there faster instead of having to having to only rely on basically your amount that you're saving. As you can see on these three examples, the amount that was saved was a total of $24,000, right? And here, the total amount saved was also $24,000. But as you can see, there was a $10,000 that was deposited into this account on top of that $24,000. So this is essentially free money. And this only depends on the interest that you're able to make, right? So this is how you can build wealth through saving and investing. Okay. So, how can you create a personalized financial plan that fits your goal? So, first, you need to assess your current financial situation. You do this by creating an income statement, which basically is just your incomes minus your expenses, which will give you a positive or a negative cash flow. A positive cash flow means that you have money left over. It means you're living within your means and that at the end of every month, you still have money left over for other important things. A negative cash flow is something that you do not want to have because it means that you're making less than you're spending. It means you're spending more than you're making, essentially. So two things need to happen in that case. You need to either make more money to be able to cover your expenses, or you need to cut back on expenses to be able to at least match what you're making. All right. So that's what you need to first do. You need to assess your current financial situation. And based on that, then you can tweak and see how you can modify things to get to where you want to be. The other thing would be to define your financial goals and identify your priorities. So after you've seen your financial situation, your positive or negative cash flow, you need to sit down with yourself and actually think about what you want to achieve financially. So you need to create your financial goals and you need to rank them from the highest priority to the lowest priority so that you can so that you when you do want to reach your goals and when you're creating a plan to actually reach your goals, you know which goals you want to tackle first. So that's important. You need to define your goals and rank them from the highest priority to the lowest priority. Right. The other thing that you can do would be to create a budget that makes sense for you. So after you have created a income statement where you can see your positive or negative cash flow, and you were able to tweak it to make sure that you're not spending more than you're earning, that's when you can do your budget. You would create a budget that you would make sure that you follow every month, where you would allocate every dollar you earn the right way. And you would make sure that you include debt repayments if you have debts. You would make sure to include savings for all of your different savings needs and goals. And you would make sure you have money for retirement savings as well. So any of your goals would fit into your budget. So that's why it's important to also do a budget. But the income statement that you would do first helps you to create your budget as well. All right. Another important thing you can do is to establish savings and investment strategy. We talked about this. It's important to save and invest wisely so that your money can grow. All right. So that you can reach your financial goals faster. And you would also need to develop a plan to manage debt and pay it off. Like I said, debt slows you down in your financial journey. So you need to make sure that you take care of all of your debts so that you can have money left over. When you take care of your debt, you would have more money for your cash flow, right? It gives you more money for cash flow and to be able to save this money so that you can reach your other goals faster. So making sure you don't have debt is very essential for you. And it also makes sure that when you go into retirement, that you don't go into retirement with debt, right? Another important thing is to regularly review your financial plan. Track your progress and adjust accordingly. You don't just create a financial plan and just forget about it. No. Financial plans is something that you have to regularly review and tweak based on how your circumstances are. As individuals, our circumstances and our life changes, right? So you need to make sure that every time that that you look at your financial plan, that it has all of your important aspects that are presently in your life, basically. That it includes all of the aspects that you have presently in your life. That's why it's important to make sure that you're always reviewing and tweaking your financial plan to include those things. So, for example, if you did a financial plan in January and then in let's say June you get married and you're planning on having children, then or your wife is pregnant, for example, that's when you would tweak it again, right? So you would need to tweak it again to see what you can change, where you can allocate what, and that will help you have a better financial plan that really addresses all of your financial concerns, basically. And finally, seek professional guidance if necessary. So if you have any questions, it's important to make sure that you talk to the right people who can help you address your specific concerns and guide you to lay out a plan that can really work for you. So it's important to seek professional guidance when needed. All right. Financial planning is not something that you can just wing, so you need to make sure that you have the proper tools, the proper knowledge, and the proper people guiding you so that you can achieve what you want to achieve financially. So let's talk about the different types of debt. So, in the finance industry, we talk about two different types of debt. We talk about good debt or bad debt. Now, good debt is basically debt that is typically used to finance investments that have the potential to increase in value or to generate income, for example. So, an example of good debt would be a small business loan because it helps you when you get a business loan, it gives you money to be able to increase your revenue, right? So that would be an example of a good debt. Real estate investment or mortgage would be another other examples of good debt because these have an asset attached to them. So when you take on a mortgage, for example, when you sell your home, you're most likely to get back that amount, if not more than what you actually put into it. So a mortgage can sometimes be considered good debt, but it can sometimes be considered bad debt depending on what you use it for. Like if it's a real estate investment, for example, um, a mortgage would be good debt because it helps you make more money. Because when you have real estate and you're renting, for example, you're renting out your home. You bought a home, you're renting it out to people at the end of every month. These people are paying you to stay in your home. So after you've deducted your mortgage and all of your expenses, you still have money left over. So that is an income. That would be considered good debt, right? Bad debt, for example, would be things like credit card debt, for example. Bad debt is typically it's essentially the contrary of good debt. It's debt that typically refers to borrowing money to finance a or purchase a depreciating asset or a non-essential item, essentially. So bad debt can be things like credit card debt, like I mentioned, high interest um, loans, car loans, payday loans. Um, did you know that a car loses up to 20% of its value within the first year? A car loan is a bad debt because it's considered, it still has an asset attached to the loan, but the problem is that usually when you sell a car, you do not get the amount that you put back into it. You actually get less because it's a depreciating asset. So that's the difference between a good debt and bad debt, right? So good debt typically helps you build wealth or improve your financial position, while bad debt drains resources without long-term benefits, right? So when you take on debt, it's important to ensure that it aligns with your financial goals and that you can comfortably manage the payments. Consider the interest rate, the repayment terms, and whether the debt will provide long-term value, like education. Is it for education? Is it for a home or a business investment? All right. So avoid taking on unnecessary debt that doesn't improve your financial position, that doesn't contribute to your overall well-being. For example, avoid taking on debt to buy a new gadget, right? A new electronic device you don't really need, or to fund a lifestyle you can't actually afford, right? These kinds of purchases often lose value very quickly, and they leave you paying interest on something that doesn't benefit you in the long run, right? So it's important to focus on using debt as a tool for building assets, not liabilities. All right. So let's now talk about how you can pay off debt. There are essentially two major ways people use to pay off debt. There's the debt snowball method and there's the debt avalanche method. Let's look at these options here. The debt snowball method focuses on paying off your smallest debts first, while you're making minimum payments on all of your other debts. So once the smallest debt is paid off, you roll the amount you were paying on that debt into the next smallest debt, creating a snowball effect. So essentially, the debt snowball method, if you want to use the debt snowball method, you would rank all of your debt from the smallest balance to the highest balance. All right. So you would pay the minimum payment on all of your debts, but the debt with the smallest balance would get any extra payment that you can put towards paying off that debt. Once that first debt is paid off, you move on to the next debt where you would put all of your extra payments towards that next debt, and all your other debts would get the minimum payments. That's essentially how the debt snowball method works. The debt snowball method is one of the is the option that actually most people prefer because it helps you celebrate small wins, because when you see that you're actually paying off debt, it motivates you and it gives you fuel, right? So that you're able to celebrate small wins, and you're able to move on to something else. So that's why people actually like the debt snowball method. The downside of that snowball method is that it doesn't consider the interest payments, right? So when you only rank your debts from the smallest balance, regardless of their interest rate, you will end up paying more interest in the long run because you're not essentially taking into account the interest rate that you have on each of your debts. That's when the debt avalanche method comes in. The debt avalanche method prioritizes paying off debts with the highest interest rates first, while making minimum payments on all other debts. It's essentially the payment, the way that you pay the debt is essentially the same as the debt snowball method. The only difference is that when you're ranking your debts, you're ranking them from the highest interest to the lowest interest. This makes sure that you pay off the debts with the highest interest rates first, and it helps you save on interest in the long run. Okay, so once the highest debt is paid off, you move on to the next highest interest rate. So the debt avalanche method helps you save the most money, okay? Because you're paying the debt with the highest interest rate, so you're able to save on interest, which helps you actually pay off your debt faster. All right. But the downside of the debt avalanche method is that it takes patience and discipline, because your debt with the highest interest might not be the debt with the smallest balance. So it might take you more time to see a win. It might make you more time to actually pay off one debt to be able to celebrate your wins and give you motivation. But in the long run, it's the one that makes the most sense financially because it's the one that helps you pay less interest, right? So choosing between the debt snowball method and the debt avalanche method really depends on each one's situation and motivation level. Like if you know that you prefer to celebrate small wins and that you prefer to pay the smallest balance first so that you can actually see progress, then the snowball method would be for you. But if you want to save on interest and you want to actually overall pay off your debts faster and pay less interest in the long run, then the debt avalanche method will be for you. It's not to say that you actually have to choose between the like when you it's not to say that when you choose one option that you have to stick to that option for that forever until you pay off all of your debts, but you can actually switch days off as you go depending on your circumstances and what you want to achieve basically. So these are the options to be able to pay off debt. So let's now talk about planning for retirement and long-term financial security. Set your retirement goals. Okay. The first thing you need to do is to set your retirement goals. You need to know how much money you need to be able to retire. There are countless calculators you can use online to figure out how much money you need before you reach retirement. All right. By using those calculators, you can see how much you need and you can start saving and to achieve that goal so that you're able to retire. So that's the first thing that you need to do. Next, you need to check if you have pension at work. Do you have pension at work? If you do and you're already contributing, that's fantastic. Keep doing that. And it will actually help you get closer to your retirement goals faster. But if you're not sure that you have pension at work, you should ask your employer if you have pension there. And if you do, it's now time to start saving, um, putting money into that, your pension at work. Why? Because employers actually match your contribution. You're essentially getting free money, so why not take advantage of it? So if you have pension at work, I highly suggest that you contact your employer and make sure that you are contributing to your work pension. It will help you get to your retirement goals faster. Okay. The other thing that you will need to do is to eliminate debt or you reduce it significantly before you enter retirement. I will not say this enough. Having debt when you're retired is not something that you want to do because at that time you will not no longer be working and will only depend on your retirement savings. So you need to make sure that your retirement savings are only there for your expenses and your expenses should not include paying off debt. You need, if you have home, if you have a house, you would need to make sure that you pay off that house completely before you enter retirement. It helps alleviate some of the stress of not working and not getting a paycheck, right? If you don't have a mortgage payment anymore, you don't have debts on your credit cards, it gives you peace of mind because then the only expenses that you would have left are your own expenses. Like, for example, if you're paying for properties, your property taxes, you would still continue to pay those, but at least you would not have the mortgage anymore, right? You will still pay for your utilities, but those are expenses that you will still need to have for your housing needs. And if you're not no longer paying for the mortgage, that's at least sometimes 800, 1,000 to $1,200 a month that you're shaving off of your budget. Okay, so it's important to make sure that you don't have any more debt when you go into retirement. Okay, the other thing that you can do when you go into retirement is if you do pay off your mortgage, you actually want to downsize, that's something that you can do as well. If you find that the home that you're in is bigger, is big when you're retired and the kids have moved out and you don't need all that space anymore, you can either relocate to and downsize, or you can rent some of those rooms, which will give you extra cash for your retirement years. Okay, so it's important to think about all of your options when you're planning for retirement. The other thing that you can do is create a retirement savings plan. Okay, there are a few different accounts that you can use for retirement savings, but the most important ones are the registered retirement savings plan and the tax-free savings account. The registered retirement savings plan is specifically designed for retirement savings. Okay, this is an account that when you put money into it, you can actually deduct this contribution from your paycheck at the end of the year, and it helps you pay less taxes per year. All right. The downside of the registered retirement savings plan is that the money that you contribute to it is meant for retirement. So it's not usually recommended to withdraw this money before retirement. So if you actually need to withdraw some of this money before you reach retirement, you would be taxed on the amount. I mean, it's only fair because you were able to deduct the contributions from your taxes and pay less taxes. So when you do withdraw from your RSP before retirement, you still have to declare, before and even after, you still have to declare this amount as income and pay taxes on it. right? So that's one of the downsides of RSP, of the RSP account. The other type of account is the tax-free savings account, where you can save money into this account. It does have contribution limits, so there's a limit to how much you can contribute to a tax-free savings account, as well as with the RSP. But the difference between the RSP and the tax-free savings account is that with the tax-free savings account, you can withdraw any amount at any time from your tax-free savings account without any penalty. So that's the difference between these two accounts. So people usually choose to save into either the RSP or the tax-free savings account for their retirement savings. So it all depends on your personal plans and your savings goals in mind. So it's important to see what's important to you basically. Like if it's being able to withdraw the money at any time, if that's what's important to you, then the tax-free savings account would be a more flexible option for you. But if you know that you can save for your retirement needs and you will not be able to, you will not want to withdraw from that account, then the RSP would be a great fit for you. It all depends on your personal needs. Okay. The other important thing would be to set realistic retirement goals, okay, and to start automating your contributions. We talked about automating your contributions and how easy they make it for you to save for anything, really, to save and build wealth. So it's important to make this process as seamless as possible so that you can save without, so that you can save hassle-free, essentially. Okay? And diversify your investment portfolio. When you do save for retirement, it's important that you have an investment portfolio that aligns with your goals. You need to make sure, remember, we talked about the interest rate. It's important to get a good interest rate when you're saving because that's what's going to make the difference for you. That's what's going to make your money grow faster. Okay. And finally, consider additional income sources. If you're able to work more, or if you're able to create a business or get a side hustle to make more money, the more money you put into your retirement savings, the more it will grow, the faster it will grow, and the more money you'll get at the end. So it's important to contribute the most into your retirement savings account, right? And finally, regularly review and adjust to make sure that you're still within your financial goals. All right. So let's now talk about the different types of insurance. Life insurance, health insurance, disability insurance, and critical illness insurance. Okay, let's first talk about what insurance is. Insurance plays a crucial role in providing financial protection and peace of mind, okay, against your various risks and uncertainties. Insurance helps cover you in case of unexpected life events. All right, let's talk about the life insurance first. The purpose of the life insurance is that it provides financial protection to your loved ones. This is not something that you inherit, it's something that your beneficiaries or people inherit after you pass away. I know people don't like to talk about this, but it's essential to make sure that you're prepared in and your family is prepared in case of your death. Essentially, it helps to replace your lost income, cover outstanding debts, pay for your funeral expenses, and it helps meet financial obligations such as mortgage payments. Let's say, for example, you are the sole breadwinner of the house. Okay, you make $80,000 a year, and let's say, for example, give an example, Tom makes $80,000 a year, and he's the only one working. And his wife Mary is stays at home and takes care of the kids. If Tom were to pass away and they have a mortgage, that they have a house and they're still paying for the mortgage, If Tom were to pass away and he was the sole provider for the family, his income will no longer be there, right, to support the family. So then Mary would have to find a way to put the kids through daycare and or get someone to come to the house to care for the kids so that she can go and work and get and have an income. Because if that's not the case, then the house could be foreclosed on because Mary's not able to make the mortgage payments anymore, right? So it's important that Tom makes sure that he thinks of about all of these eventualities in case that he passes away. He needs to make sure that his mortgage payments and his income are replaced when he's no longer here. So that's what life insurance essentially is. It's a protection for the family. There are two types of life insurance. There's a term life insurance and there is the permanent life insurance. Term life insurance is essentially as if you're renting life insurance. It's a life insurance policy that you would get for a certain period of time. Like the name suggests, term life is for a specific term. You can get it for 10 years, 20 years, 30 years, etc. And permanent life insurance is life insurance that you would have for your entire life. Okay, it's a policies that would have cash value sometimes that accumulates over time and that can be accessed during the insurance lifetime for other specific needs. So it's a difference. These are the two different types of insurance. The term life insurance could be useful for something like, for example, mortgage insurance. Okay, it's something that people take usually for if they know that they need a protection for a set amount of time. Let's say, for example, this Tom and Mary that I talked about that have the house in a mortgage, they would want to get mortgage insurance so that when Tom passes away, the mortgage is completely paid off, right? And mortgage insurance is what does that. Usually, people don't pay this for 50 plus year or for their whole life normally. When you get a mortgage, you want to pay it off, or you hope that you're going to pay it off within 25 to 30 years. So essentially, Tom would might only need the mortgage insurance for maybe 20 years. So he would get coverage for his mortgage for 20 years, right? This would be what term life insurance could do. Um, the permanent life insurance would be for the whole life. Now, the difference between the term life insurance and the permanent life insurance, apart from the terms, basically with term life, once you're covered for 20 years, if you reach that 20 years, you're no longer covered. You don't have coverage anymore. With permanent life, you're covered for your whole entire life. The difference between the term life and the permanent life insurance is that the term life insurance policies are way less expensive than permanent life insurance. All right. I mean, it's evident that when you're covered for only 10 years, at the end of the 10 years, the insurance company knows that after 10 years, they do not have to pay for a death benefit. Whereas with the permanent life insurance, they know for sure that at some point they're going to have to pay for this death benefit. So that's the difference. And that's why the permanent life insurance is more expensive. But essentially, the type of insurance that you get depends on your personal circumstances. This is where you would need to reach out to a life insurance agent or an advisor to help you decide what type of insurance is best for you and your family. All right. The so now let's talk about the health insurance. So, what is a health insurance? The purpose of a health insurance is that it helps cover medical expenses and it provides access to healthcare services. Okay? Um, there in Canada, we do have the Medicare, which covers a few different medical healthcare services, but it doesn't cover everything. It, for example, doesn't cover your eye treatments. Like if I needed, I wear glasses. So if I needed glasses or, consultation for my eyes, I need to have a specific healthcare insurance for that. I need to have a personal health insurance for that. Or I can use my employer health insurance. If you're employed, you normally have a health insurance with your employer. All right. And that helps you with things like getting glasses, or if you want to have something done for your teeth, if you're going to the dentist, those are things that are not covered by Medicare and that you would need to have personal healthcare plans for. All right. So that's why it's important to have health insurance. Okay. It helps you make sure that you're covered in case you have emergencies for your eyes or for your dental issues. Like if you have a toothache, for example, and you need to go see a dentist, that's not something that would be covered by Medicare usually. So Medicare is different by province. It could be different. I'm talking about the one from New Brunswick because I'm in New Brunswick, but it could be different where you're located. So it's important to make sure that you check Medicare and check the limitations of Medicare, so that you can get coverage for your health insurance in case you need it for an unexpected health wise. Okay. So let's now talk about disability insurance. Disability insurance provides income replacement if you become unable to work due to a disability, an injury, or an illness. Okay. Your employer usually has something like this where when you become disabled, you still continue to get money until you're able to get back on your feet. But sometimes it doesn't cover your whole, it doesn't completely replace your income. So you need to make sure that if you have disability insurance, that it covers you completely, or if you don't have it, then it's something to keep in mind because it helps you replace your income when you're sick or unable to work. Okay, there are two types of disability insurance. There is a short-term disability and there's a long-term disability. Short-term disability insurance covers 3 to 6 months after a waiting period. It's basically a disability that provides you an income for 3 to 6 months after a waiting period. The waiting period is usually 30 days, 60 days, or 90 days, depending on the insurance that you were able to get. So after the waiting period, that's when you would start getting the disability payments. And for the short term, it would cover you for 3 to 6 months, depending on what you have there. The long-term disability insurance usually offers the coverage for an extended period of time. Let's say this would be for someone who maybe had a stroke and is not able to recover from the stroke completely and still has some issues after the stroke. This person would get the long-term disability. So after they've gone on the short-term disability and they received it for however long they're covered for, 3 to 6 months, after that, that's when they would get on the long-term disability insurance. And this would cover them for the long term or until retirement, okay, if they're no longer able to work due to disability. So disability insurance is another important insurance you should have in your financial planning, right? So let's now talk about critical illness insurance. Critical illness insurance is designed to provide a lump sum payment upon the diagnosis of a covered critical illness or medical condition. It's essentially an insurance coverage that gives you a lump sum to the policyholder if they are diagnosed with a medical condition. And every critical illness insurance is different It all depends on what you choose to include into your critical illness insurance, okay? But usually what's covered would be things like cancer, heart attack, stroke, organ transplant, major organ failure, terminal illness, etc. This would be a lump sum payment that you would use for anything. So if you do have critical illness insurance, for example, for let's say $50,000, and you have a coverage condition, basically you were covered for example, if you had a stroke and you did have a stroke, you would just put in a claim, and after your claim, the insurance company would pay you $50,000, okay, because you had this stroke. And this $50,000 can be used for anything. It's not, once you receive this $50,000, you can use it for your medical condition. You can use it to, I don't know, if you needed to modify some things around your house to be more adaptable for you. This would be a $50,000 that you can use for anything, really. But at least it gives you this lump sum amount of money that you can use for anything that you want. So that's what critical illness insurance is, and should also be an important component of your financial planning. Okay, we've now reached the end of this webinar. I hope you were able to follow and stick around up until the end. This was a lot of information that we covered here today. I hope you took some notes. And if you have any questions, like I said, I'll be leaving my details in the next slide so that you can send me a message about that. But if you're ready to take the next step and transform your financial future, I have a lot of exciting offers for you. First, I offer personal coaching sessions where we dive deeper into your financial goals and create a custom plan specifically for you. Okay. Together, we will focus on what's best for you on these coaching sessions and ensure that you have the support you need to be able to reach your financial goals. So, in addition to coaching sessions, I also offer a course that's titled Financial Fresh Start, your step by step guide to financial freedom. This course is the perfect way to learn the fundamentals of personal finance in Canada. It's a step by step guide that helps you learn on your own time at your own pace. It's designed for beginners, so you don't need to worry if you're just starting out. This is an easy to follow lessons. It's got 6 modules with a few different lessons, lifetime access, a complete Excel spreadsheet that includes sections like net worth, income statement, financial goals, debt payoff, retirement planning, retirement disbursement. It's got a lot of information. This is a course that's jam-packed with information and an Excel sheet to help you calculate your budget as well and more. So, if this is the course for you, or if this is something that you want to get, I do have flexible payment options for either the coaching sessions or the course as well. And if this is something that you would want to know more about, I'll leave the links down below, and I'll also send an email that will explain how these two work. About the coaching sessions, I do offer free discovery calls, one-on-one, just to see how we can go ahead and tackle your specific needs. And based on that, I can provide you with the coaching fees that you would need to pay so that we can start on coaching. So these are the two options that I offer. If you wanted to talk more about these, feel free to message me or feel free to check out these links that I'll leave down below for more information on the coaching sessions and the course. So Like I said, this is my information. So if you want to give me a call or send me an email, this is my email, info at thecanadiansaver.com, and the website you can check out. It has the information about the coaching sessions that I provide. It's thecanadiansaver.com. And again, my name is Awa, and I hope you enjoyed this webinar. And until next time, welcome. Thank you for joining me today for this webinar titled Introduction to Financial Planning. My name is Awa, and I am a licensed financial security advisor in Canada. A little background about myself. I am originally from Senegal, which is a country in West Africa. I came to Canada about 15 years ago and studied finance. So I have a finance degree and I've worked with different financial institutions over the years, helping clients with their financial journey. Now I am a licensed financial security advisor where I help clients with their savings, their insurance, and their retirement planning needs. So, welcome and thank you again for joining me today. At the end of this session, I will be providing my information, my email, my telephone number, so that you can reach me after this webinar if you need to, or if you have any questions. So let's get started. I hope you are ready and that you came with an open mind and something to take some notes because we'll be discussing a few different topics today. Right, so let's get started. So, on the agenda today, we'll discuss understanding the importance of financial planning. We'll talk about why it's important to set financial goals. We'll also talk about an overview of budgeting and why it's important to budget. We'll talk about how to create a personalized financial plan that fits your goals. We'll also discuss how to build wealth through saving and investing. And we'll talk about understanding different types of debt. We'll also talk about how to repay debt, the debt repayment options. We'll dive deeper into planning for retirement and long-term financial security. And finally, we'll talk about an overview of different types of insurance: life insurance, health insurance, disability, and critical illness insurance. So, as you can see, we've got a broad range of subjects that will be discussing today. So let's get started. Understanding the importance of financial planning. Why exactly is financial planning important? Well, it's important for a few different reasons, and let's talk about these reasons. Financial planning helps you with budgeting and spending control. Do you know where all of your money goes? This is probably a question you've asked yourself multiple times. You've probably heard the classic advice, don't spend more than you earn, and for good reason. While this quote is simple and everyone should abide by this, it's the golden rule of financial planning for a reason. Okay, budgeting helps you understand exactly where your money is going so that you can make smarter choices and avoid that dreaded paycheck to paycheck cycle. It's not about restricting yourself, it's about prioritizing what truly matters to you. Budgeting is about giving every dollar a task so that you're in control of your finances and so that you don't let your impulses guide you. Okay. Creating a budget helps you take control of your finances and set the foundation for achieving your bigger goals. It helps with identifying your your goal aspirations. Okay. What do you truly want to achieve with your money? Whether this is retiring early, buying your dream home, or taking a once in a lifetime vacation, financial planning starts with your goals. Okay. Think of it as like a Google Maps. If you don't set a destination, you'll just keep driving in circle, not knowing where you're going or how you're actually